hard to understate how massive the changes have been in the last decade in this space.
Hello everyone, I'm Vincent and this is Resonanz Spotlight. Today we are kicking off a special two-part mini-series diving deep into the world of systematic option-based strategies, a powerful and evolving area of quantitative investing. This series features two incredible guests from the Systematic Trading Strategies group at Goldman Sachs, both of whom are joining me in the studio across both episodes. With us today is Chris Miller, Head of Equity Volatility and Derivatives Product at STS. Chris, welcome to the show.
Thank you for having me.
Thanks. Joining us, we're speaking with him in more depth in the second episode, is Nick Baltas. Nick heads cross-asset Delta One, commodity and stock systematic strategy within STS. Nick, good to have you here.
Thanks, Vincent. Good to be here.
Let's begin with episode 1, volatility trading. Chris, let's start with the big picture. How has the option market evolved in recent years to enable systematic volatility strategy across use cases, yield generation, defensiveness, and relative value?
This could easily become an hour-plus session just on this. We're going to try to stay high level, but it's hard to understate how massive the changes have been in the last decade in this space. I'm humbled working in this space because a lot of things that I thought I knew, you have to sort of relearn given the advancement that we've seen, which I'll speak to in just a second. Big picture, I would say there's maybe two things that I'd like to talk about, but I could go a lot deeper. The first is, I think most people talk about shorter dated options that have been coming to the market, but I'd also like to emphasize today that not just shorter dated, more granular, meaning even the longer dated ones, you have more expiration. This impacts how we think about designing things. The second, also increasingly important, is the actual participants in the market have changed dramatically, in particular retail growth from ETFs. Several years ago, there were changes that have made use of derivatives in the US ETF market much more easy, and there's been a huge uptake in this and quite a bit of innovation in that space. Feel free to interrupt me if you'd like, but maybe just to elaborate a little bit more on both of those points. On the shorter dated, I'm not exactly sure what the background is of everyone. I assume for listeners that you don't know a lot about options, but generally know what they are. Many years ago, it was really, even on S&P 500, the most liquid options market, you would have monthly expiry options once a month, quarterlies out a little bit further than that. And this let people take bets on where the market was going to be the next month. A lot can happen over a month, right? There's multiple events can come out, election and FOMC announcement can come out. And so there's not a whole lot of granularity there. The change has been starting around, let's say, 2010. I'm not exactly sure when Friday expiry started becoming a thing in S&P, but certainly around 2016, 2017, when Monday and Wednesday expiries were introduced. And then certainly in 2022, whenever every single day of the week was listed in S&P 500 options, there's been this huge uptake of people using short-dated options. I would also say very precise options in the sense that if 4 days from now there's some sort of event in the market, I can actually look at the options market and tell you, based on the 4-day versus 5-day expiry options, what is the market pricing for probabilities of different outcomes. And this has lots of impact on all sorts of strategies.
Thank you. I think you mentioned a few topics.
Yeah.
Let me zoom in on some aspect. We mentioned liquidity, and so for me, the topic are ETF and liquidity. So let's take the example of the S&P Vol surface. So can you speak to what's changed there in terms of tenor and strike liquidity, and what has been driving these flows?
Sure. We look at this quite a bit. It informs all of our strategies. We look at it not just in terms of the liquidity profile, but also in terms of the flows. There are data sources that allow us to see for every option that's bought and sold, not who the buyer and seller is, but the type of buyer and seller. We can deduce things like certain areas of the vol surface. There's not just a lot of volume that's trading, but most of the buying tends to be retail, or most of the buying tends to be banks, et cetera. And this allows us to have a very rich understanding of what's going on across S&P. And I think we focus a lot on this podcast today. It's interesting because there's so much diversity across it. Maybe to speak to that more concretely, in terms of liquidity and volumes, there's been this massive uptake of the shortest dated options options having the most turnover and the most near at the money options having the most liquidity. Some of that is also just the nature of the beast in the sense that if you're trading a 1-day option versus a 1-year option, you need to turn it over every day. And so you do see higher turnover naturally. What I would say that we spend more time on is this like science data about where different people buying and selling. For many years, can you see it in the data? Call selling in the monthly space is incredibly common. We'll probably talk about it more later with retail growth, but this has become even more common and more pronounced. And put buying from buffered products, just general hedging of people, really creates a skew dynamic that I think is I'm not the first one to discover, and we'll talk about a bit later. I think in the shorter dated space, there are a lot more interesting things going on. We see buying of the wings for different use cases, speculation and hedging. We see interesting effects, people selling optionality across 1 week as a standard thing that creates very noticeable flows in S&P markets that all creates an environment where you can start doing relative value, where you can start being creative in the space. And that's not common in other markets.
So you mentioned a few times a short-dated option, and for me to bring the topic of the shorter one, I think they call them correctly the zero-day option. This topic puzzled me. So is it mostly about noise, or do they create some pattern or systematic opportunity that can be captured on an intraday basis?
I think everything is a mixture of signal and noise at the end of the day, at least in the market. There's like some truth in either perspective. When I talked about massive changes earlier, this is probably the main example where it used to be that we only had VRDTs once a month and it wasn't very common to look at. Now it happens every single day and it's a huge topic of interest. We've only been looking at them for about 3 years. So from a statistical perspective, it's still relatively new. Generally, there are definitely use cases. These are here to stay. Some of those use cases are enhancing risk profiles of existing strategies. For example, things that we see definite value in many people doing is buying protection, buying upside convexity. An example would be if you wanted to bet intraday on buying S&P, then you actually would just go buy S&P futures, then face potential downside. Now you can try things. Maybe I should buy S&P calls, pay some premium, but get the upside and have a more protected downside profile. There's no free lunch. It gives people enhanced risk profiles, and we've definitely seen interest in that. We see lots of cases, people delta hedging, creating carry strategies. It's a whole new world, what's relatively new in the grand scheme of things. I would say that there's a couple sort of topics that are interesting, like, from a signal to noise perspective, our initial cut is that the wings have a bit more dislocation. That's intuitive because who is selling the wings? Probably not a lot of people. You can imagine lots of people that buy cheap calls and puts every day. Initially, it seems that the near at the money is a bit more fair because there's lots of use cases there that I alluded to. Delta hedging, which is something quite surprising the first time I heard about it. But it's definitely goes both directions with these.
Just talk about supply versus demand on the wings. So that brings me to the topic of volatility risk premium. In my understanding, this is a financial economics concept. From a practitioner point of view, looking at the empirical evidence, how do you think about it versus the academic foundation?
Sure, yeah. I mean, first, empirically, there's kind of, in my opinion, a sniff test in some sense, which is, does it feel like there's something there? Whether you're talking about a variance premium, a skew risk premium, dispersion risk premium, these are well established. We've provided systematic strategies for these for years. In terms of a sniff test of people sort of see them working over long periods of time, from an academic perspective, it depends a lot on exactly how you define these things. Mm-hmm. I remember whenever I was new in this space, when you look back at the literature, there's actually variance risk premium, VRP. And then if you look at a lot of bank marketing, there's volatility risk premium, also VRP. They're subtly different things because one is talking about convexity and squares and the other is not. Without going into it, I would just say that an easy example where they seem incredibly similar. They're actually slightly different things. Just by tweaking the definition, you can come to a different conclusion, and that can often cause confusion. I think in terms of implementing these things, always a question of how pure of an exposure you want versus what other bells and whistles you want to have embedded with it. We have seen people do very pure dispersion trades, very pure skew trades, variance trades. I think there's certainly demand for things a vega neutral dispersion, which isn't academically pure, but sort of sits in a portfolio in a better way, even though it's not academically pure.
Right. So from an allocator point of view, one common criticism of vol trading is the path dependency. How do you go about it? Is there a framework that they help mitigate that? Is there a trade-off between reactivity, carry costs, and basic risk?
Yeah, look, I think maybe starting with simplest possible example to illustrate the issue, right? Is imagine you want to do defensive hedging strategy and you just buy a 1-year put and then wait a year and roll it. Then, that 1-year put, and let's say to be concrete, it's at the money put, let's say. Then if day one market sells off, then you're great. But the problem is that if day 6 market sells off and you've been up dramatically in the 6 months, then all of a sudden you have no actual defensiveness. This is a legitimate criticism if you do very naive things, but we have lots of ways. This goes back to the granularity point I was hitting on. Even in my simple example of the 1-year option, unfortunately, our everyday listed 1 year, but what standard practice is to trade a small amount of this option every day rather than having one-year option that's based on where market was in that day. You have a package of 252 of these based on where it's been over the last year. That might be painful for you. Maybe this is my plug for systematic trading strategies, which is what we do.
You briefly mentioned delta hedging. So today we have a weekly, even daily option. How does that affect what's possible or can be done with delta hedging?
I would say 2 trends in the marketplace that I at least think about. The first is speed at which you delta hedge. Second is I would just have how you delta hedge, or maybe modeling is the more precise way to put it. I think the first is more interesting. In terms of speed, how I think about it is you go back to the example of the 1-year option. What is 1 day versus 1 hour in the life of a 1-year option? But then if you go to the opposite extreme and imagine a zero-DTE trading option that expires at the end of the day, and I want to delta hedge my option once a day, that doesn't even make sense. It's gone by the time you delta hedge it. So, there's a whole spectrum to the middle, but I would say what sort of at least my part of the ecosystem has been learning to think about the fact that as you get shorter dated, you need to, from a risk management perspective, have better infrastructure to have faster hedging. But then there are also trade-offs. You don't want to do this so fast that you're just burning cash hedging small moves. In the past 5 years, lots has been done on how do we think about being reactive, but also not just over hedging. Modeling, I would just maybe note that it becomes back to me having to relearn things. Incredibly important whenever you think about how do you even calculate the delta of a zero-DTE option, because without going into a lot of detail, I would say assumptions that we normally make, volatility roughly stays constant over the day, just break down dramatically because with the zero-DTE option, assumptions are not right. During the course of a day, there's dramatic seasonality of volatility in market, and it introduces lots of modeling risk, but it's a really big topic.
Very interesting. So moving on to a different topic, option strategy are almost always about tail risk. So how do you approach managing tail risk in particular? And how do you manage it without breaking the cost efficiency of the entire approach?
Generally, there's no consensus correct answer here. I think probably 2 main camps that we see people do. One is you create your carry strategy. You don't really worry too much within them at the moment about the tail risk. And then on the basket, put on top of it some sort of very, very efficient tail risk, which is at least the first pass, not necessarily precisely linked to different strategies. Though I would just say there's been a lot of innovation in that space as well, given the options. I think the other approach, which I think is probably better, is buying protective calls. So say you're selling a 15 delta put, you make it a 15 delta, 1 delta put spread. Very common to do. And I think the advantages of this approach is that you don't have to be really going into the weeds to understand why it's protective. You're no longer selling a put, you're selling a put spread. And so I think that's the dummy, keep it simple approach to do, that you have to be very careful that these 1 delta puts add up. If every 15 delta you buy a 1 delta, it makes sense, but it's something you have to monitor if you're doing it every single strategy. Conceptually, we see some clients actually, if they're willing to drill down at the strategies, find some more cost effectiveness by doing the first approach I mentioned.
What's your take on timing entry and exits in vol trades? Do you see reliability there, or is it just mostly about chasing mirage?
I guess how I'd answer this is it's all about benchmarking and how you define things. It ties back to what I said earlier about academic literature around risk premium. And what I mean here is, let me give an example. So common study that we've done on our side is if volatility levels are high versus low, how does the subsequent performance of the strategies behave? And, obviously different strategies give different results on this, but I would say broadly a very common outcome is that you first do this on returns of strategy given high vol versus returns of strategy given low vol, and you get higher returns and high vol, lower returns at low vol, and you're amazing. I figured out timing, right? And everyone's happy. But then it gets a little bit more nuanced because someone comes to you and says, actually make it a Sharpe ratio given high vol, Sharpe ratio given low vol, and all of a sudden the thing like dramatically flattens. I think, you have to be very careful here. It's easy to get overly excited. We have seen evidence that if you do this in a cost-conscious way, particularly if you try to build from a bottoms up, meaning not rebalancing strategy up and down, but instead within the strategy, changing the amount that you trade over time, there is some evidence you can have timing work. At least in my personal experience, I would say that if not something goes from like a 1 Sharpe to 2 Sharpe, I think it's more something goes from a 1 to 1.2, at least maybe using as an enhancement on top of an existing strategy. I think if you're talking relative value, long short based on timing, probably still be a different animal. But in terms of timing within skew, timing within the dispersion, I think that's the realm of what you're talking about for improvement.
There's often a misconception that volatility strategy are just short vol or crash protection. What's for you the single biggest myth you most commonly hear about systematic vol strategies?
Interesting comment about the crash. I would say there are other misconceptions. Not everything we do is selling volatility. There's lots of opportunity to do interesting things in long volatility space. Lots of client conversations around how to have the lowest carried long strategies, either in index vol or in dispersion space. With respect to your point about crash, there are crash strategies. There's a certain client base that those are important for, and risk sharing is important in the marketplace. Different people have different risk preferences, but certainly not everything. Even within that space, there are prospective versions. I would also add, we don't know everything. Sometimes people, when they join the desk, want to know what textbook do I read to learn about this. And I don't think you ask 5 people what the delta should be in your option, you get multiple different answers, surprisingly. I think there's this conception that this isn't a space that is still evolving and changing. I hope that's something I sort of, hit home pretty hard, is that new things are happening all the time and we don't have all the answers, frankly.
All right. Thank you, Chris. So this has been a great deep dive. Next time we build on today's conversation with Nick Baltas, exploring how to aggregate these strategies into a broader systematic portfolio. Nick will walk us through correlations, factor interplay, weighted scheme, and model design. Stay tuned for part 2.